Hello, this is Daniel Want from Prerequisite Capital Management. Today we're going to provide a video overview summarizing some of the key aspects of this recent quarterly client briefing that we've issued. This obviously is just for general information purposes only and should not be considered as specific advice. So the general theme is just looking at the reasonably unprecedented environment that we find ourselves in today, and especially looking at how we navigate and grapple with that as investment managers and portfolio managers, trying to make sense of what's going on and hopefully steer a safe and profitable course through what is unfolding and what is likely to unfold. Now, before we just start to explore a few different things, we've decided to release one of our recent PCS reports that we produced or published middle of last year, but it establishes a very useful background to the discussion around the government policy response and central bank policy response around the world, and trying to just frame some of the key principles at play and some of the key issues that we need to be thinking about in terms of understanding that. We've just received such a tidal wave of questioning around government actions and the likely knock-on effects in different currencies and investment markets. If you were to summarize and oversimplify the general line of questioning and thinking, is that the first order thinking that is prevailing at the moment, where everyone is seeing these significant fiscal and especially monetary policy measures being announced, is that will naturally lead to currency debasement, and particularly an inflationary context where bond markets could be in a significant amount of trouble. Now, as is usually the case in this world, first order thinking is typically dangerous. It doesn't mean that it's always wrong, but it usually means that you need to pay a lot more attention to what is going on, especially to second and third order effects, and especially to the context that different things are happening within, because the path that we may need to chart from an investment point of view might be a little bit different than what is initially suggested from a first order sort of impression of what is happening. And we would like to suggest that that is absolutely the case at the moment. PCS 34, if you click on this link, it will take you straight to it, starts to establish the context to how we would suggest we need to be thinking a little bit about what is going on presently, and future PCS reports will go into quite a lot of detail as to what that practically will outwork and the different pathways in the different asset classes and currencies and all of this. So back to this letter, one of the key points is that, a lot of the investment paradigms that conventional portfolio managers and investment committees have operated out of are typically just the result of the last 50 years worth of experience. And that is sort of reinforced itself to the point where a lot of these investment committees and even investors are thinking alike, and they tend to engage with the world and their decision-making processes in a reasonably somewhat uniform manner. Our contention is that the tools and the paradigms that they've used up until now are going to be somewhat of an Achilles heel to them in the years to come, and the environment and the regimes that we've shifted into. And so we also present a direction to a solution, of course. In many regards, almost 20 years ago, when I started to really get serious about trying to understand how the world works and markets, and especially in terms of how to operate from an investment point of view, it was fairly plain to me back then that I'd be, for most of my life, dealing with a world that would likely be on the other side of this multi-decade global credit cycle. And in the aftermath of the over-indebtedness that we were very predictably going to be in, the traditional investment paradigms, although being useful, were probably going to be somewhat limited. So learning the traditional sort of Warren Buffett style valuation paradigm and approach is highly valuable and a useful starting point, but in a world where a lot of these mean reverting dynamics would prevail, that we've seen in the last 50 years, in a world where those regimes, those underpinning structural regimes were breaking down and threatened, especially with more desperate governments and more desperate policy making sort of environments, that sort of a paradigm would likely to be less useful. And I started to realize that, well, at the end of the day, capital flows are primary, valuations are just an effect or a secondary effect of those primary dynamics that were being driven by the flow of capital. So whether capital concentrates into a particular asset class or investment category or currency, it's understanding the system that is causing the behavior in that direction for that capital to move and to cluster into certain areas or to dissipate. That was key. And when it comes to navigating an uncertain environment where we're dealing with the unwinding or the realities of the excesses of the past in the form of over-indebtedness and structural imbalances, especially from a global perspective, that we've seen over the years, especially with the sort of build-up of globalization and the reasonably cooperative world that we've more or less seen for the last 50 years, especially watching that pulling itself apart and becoming much more competitive and less cooperative, and those balance of payments imbalances potentially being threatened, which portends for some pretty significant issues in the years to come. Our most recent PCS 48 report went into a lot of that in a lot more detail. So coming back into this report, one of the things that is now has a premium to it is being able to understand the behavior of capital, how it is moving, so following the money, so to speak. Because there's going to be a lot of disorientated dynamics or disorientated capital movement in the world. And because of the magnitude of the policy responses, we're going to have probably at times some very persistent but paradoxical movements in the flow of money or the way capital moves around the world. And so instead of trying to take a fundamental view of the world and project our fundamental view on how the world should be, this is more of a philosophy that starts to just observe what is, how is capital behaving, and why is that behaving in that sort of a manner, and then seeking to identify stable and unstable conditions in that movement of money. So when participants are excessively uniform in their positioning and their thinking about a given market or economy or asset class or currency, then that particular market becomes vulnerable to a shift or at least instability and volatility. And so we've developed an array of very practical tools to measure and map money flows, the inherent market structure, so learning to look beneath the surface of any given exchange traded market to see the health or otherwise of those underlying liquidity conditions and the positioning, the structures inherent to any given market, so we can identify vulnerabilities and also unappreciated strength in different market trends and dynamics. And so one of the reasons we've been able to, obviously we never foresaw the virus pandemic, but we were already well positioned ahead of it, purely because we could see the vulnerabilities or the instabilities that had been building in different asset classes and different dynamics around the world, especially in the banking system. So we're already positioned to be able to benefit from any unexpected stress in the system, because that unexpected stress will tend to run along the lines or express itself in the direction of system vulnerability. And so learning to track money flows and positioning and different structures in the world, that helps you, at least at the margin, to skew some of your portfolio exposures accordingly. So if we looked at the way our portfolios have actually behaved over the last month or two, which we can see in this chart. If you were to just look at our portfolios, it's within the range of normal fluctuations that we've experienced for the last 7 years. You wouldn't actually know that the world effectively just blew up. But when you look at this grey line, which is the Australian stock market, total return, so with dividends reinvested, you can start to see the magnitude of what we've just sailed through. So our mandate is still very much on track, largely because we've developed ways to see beneath the surface of any given asset class or securities market or currency. And we can, at the margin, balance, lean into things or lean against things as well. We also have some primary understandings as to what drives different asset classes and currencies, which can be oversimplified to growth, inflation, and capital flows, which we've talked at length about in the past. And so we diversify these fairly conservative portfolio mandates in a way that they're likely to be resilient amidst any unexpected, either positive or negative change. So far, our portfolios have done really well, or they've been resilient, and they're continuing to perform as they're designed to. So when it comes to more conventional investment committees or investment managers, or just even individuals thinking about how to manage their portfolio, when you go down the rabbit hole of trying to be able to measure and map capital flows or the movement of money, trying to understand the way different participant groups are positioned in different markets, you soon realize that it's actually a very difficult objective in practice, because all of the different sentiment surveys or institutional money flow data sets, they're all very limited in their sample sizes. They're also they're constructed under a variety of different methodologies and approaches. The commitment of trader reports out of the US are only on a very limited number of markets that are traded on futures exchanges over there. Any given market these days, for stocks, for example, there's a variety of different ways they can be traded, either in dark pools or on exchanges, on different exchanges around the world, even over the counter to a degree as well. And so there's a lot of expressions of where trading and price formation, or a lot of influences to price formation, which go beyond just narrow markets. So trying to really get a handle on what is actually happening from either a capital flow or a money movement perspective, and then also the inherent positioning of different groups, and either the stability or instability that is underneath any given market, can be very difficult to actually do, especially on an apples for apples basis, where you want to be able to compare what is happening in US bond markets with some industry sector equity index on the other side of the world. You don't necessarily have a COT report for everything, and some of those COT reports are actually reasonably narrow in the activity that they're actually capturing underneath any given market. So obviously, as the old saying goes, necessity is the mother of all invention. And so for the first 15 years of basically me being interested in all of this, I've been trying to find a better way to be able to measure and map all of these things. In the first 15 years, I basically failed miserably in trying to find that better way. A few years ago, stumbled across a variety of different things where I learned that in aggregate, human behavior was more patterned and more predictable than I ever imagined. And so we were able to develop a whole variety of these different tools to be able to, just using basic volume and price inputs from any exchange traded market, to be able to synthetically recreate what those participant groups and those different money flows were actually doing. And so here, if you see halfway down page 3, there's a link to a presentation we released a little while ago that gives a bit of an introduction to some of these tools that we're talking about. So one way you can think about it, it's like a synthetic reproduction of the commitment of trader positioning reports, but it's actually a lot more involved than that. But this presentation, if you look through it, you can see just the practical utility of these tools that we've been able to develop, the timeliness, the applicability to any exchange traded security, including individual stocks, and how it's married up, especially relative to, say, our patient money flows has been amazing in how it captures insider trading activity, for example, from CFOs and CEOs in different markets. Our speculative money flow measures are amazingly useful relative to a lot of the more popular sentiment measures, and even the commitment of traders reports themselves, so the small and the large trader activity, global fund manager surveys. And so typically we find when you see a divergence between some of our tools and some of the more popular sentiment measures or investment money flow gauges or commitment of trader reports, with the benefit of hindsight, usually 9 times out of 10 our tools have proven the more accurate signal generating approach, as opposed to whatever that more narrow sample sized sentiment survey or commitment of trader report indicated. So even here we show on slide 12 our tools underneath that show the behavior of different participant groups and flows underneath the S&P 500 in the US, overlaid with what I believe to be a fairly credible index constructed from dark pool activity, so off exchange activity in S&P 500 stocks, that measures the big ticket activity, so the big money activity in dark pool environments underneath the S&P 500 stocks. And so you can see here how our patient money flows pretty much mirror the majority of what is identified in these, at least in this particular dark pool index, with some variations. But even back here in late 2012, by this dark pool index, they had a net selling sort of activity by the big money sort of more patient pools of capital, whereas our patient money flow tool was actually showing significant accumulation. And so with the benefit of hindsight, it was our money flow tool which in theory has a more diverse sample set to it, as opposed to the more narrow dark pool index here. Anyway, you can look through this at your own time. There's a variety of different examples. But anyway, in looking at those, in trying to trace what is actually happening, and at least in a first instance, when you're seeing the behavior of significant pools of capital in certain groups, it's great to kick off a research effort, to really try and dive into what is actually happening in the system. And the deeper the insight you get, the more foresight tends to arise. And so over the next few pages of this quarterly letter, we provide a variety of different examples. So this is a very current one at the moment in the euro area, where we're seeing that this is probably one of the last opportunities for hedging euro exposure, or at least starting to get out of eurozone assets, depending on what your mandate is, or at least getting serious about considering this as a scenario, because the broad euro currency index is significantly overdone on the upside, especially from a speculative point of view, and underlying liquidity and capital movement have been falling away significant. So there's a broader exodus that's going on of Europe, of underlying activity away from European markets and assets and currency exposures. And so this is likely to catch up with a significant downside or depreciation in the euro currency against most currencies in the world. It's almost an inverse setup here as what we saw, where you actually wanted to be accumulating eurozone exposure and currency exposure in particular back in the early 2000s. Showing the usefulness of these tools, especially in understanding interest rate cycles, which really are reflective of broader growth and inflation conditions. These are the Eurodollar futures. So if you take 100 minus a rate, that this is the value, or at least the way we've expressed them here. You can see an over speculative condition, so back in 2018 roughly we could see effectively what were top of interest rate cycle conditions where patient money was massively accumulating Eurodollar futures. So they were starting to really de-risk balance sheets and starting to lean in the direction of trying to prepare for a falling interest rate cycle effectively. At the same time, the speculative community in the world and the popular narrative was that interest rates were just going to keep going higher and higher and higher for a variety of different reasons. And so that enabled us to see, the fact that we were likely in that topping condition with regards to interest rates and likely to transition into more of a lower interest rate environment, especially in the US. Also to just show the usefulness of patient money flows. So those big ticket, more fundamentally driven market participants in the Eurodollar markets. If you just push forward those patient money flows, so this dark blue line here, push it forward 3 years, and you basically have this self-fulfilling dynamic where when the patient money crowd start to de-risk, 3 years later, we usually end up with some sort of a crisis or blow up or liquidity issue in the world. We built this chart back in the middle of 2017 and suggesting that somewhere between, especially 2019, 2020-ish, likely to be big issues from a liquidity perspective. And, with volatility expansion, more restrictive credit environment past a point, et cetera, et cetera. So these were the candidates of this possible crisis that we saw coming. Or at least this methodology suggested was probable. If you want to understand this a little bit more, I suggest you watch this video of a presentation I did at a gold conference where I was talking about different leading indicators of both sovereign credit default cycles and also non-sovereign, so private market and corporate credit default cycles in the world, and different ways of trying to get a leading sense for that. But just click on this link at the bottom of page 4. To go and watch that if you haven't. Similarly, we can see the utility. So this is for the Australian banks. So in 2018, we could see that timing was just not right to really go all in on some sort of a big short that most of the hedge fund world were keen or actually had on in a fair bit of size. We could see the bigger patient money flows actually accumulating our big four banks, which was quite frankly a little bit surprising for us to see, but that catalyzed a lot of deeper research that we did into that sector to find actually, in fact, it was just a little bit too premature to get, end of the world bearish on Australia's big four banks. We also speculated at the time in 2018 that this dynamic could shift very quick, and so we'll, as we excerpt from some of our previous research, and now at the end of 2019, some 24 months later, we saw massive distribution. So the bigger money actually selling our banks in earnest at the end of 19 and early into this year, in January especially. And as is often the case, not always, but this patient money flow crowd tend to be reasonably prescient in what's going on, because they're trying to assess price of what's price relative to their assessment of underlying fundamentals and underlying fundamental realities. And so when they're distributing en masse, that's usually a sign to sit up and pay attention, because we need to explore the potential for a fundamental, significant deterioration underneath that market from a fundamental perspective. This this liquidity turning point signal methodology is kind of just looks to identify a critical mass of conditions where you have uniformity of underlying positioning from a variety of participants and also uniformity of thought. This is actually a mathematical definition that underpins this, but whenever it triggers this blue diamond, either a minor or major signal, you've usually got a greater than 70% chance of a significant correction or a change of trend or some sort of change in the momentum structure. And we can see these things building weeks and sometimes months in advance. And so on January the 2nd, we published in our chart pack, the fact that this minor liquidity signal was building but hadn't triggered yet. On the 3rd of February, it actually triggered finally. And then we all know what happened after that. Obviously, this says nothing about the potential magnitude of what comes next. It's just 70% of the time this is a high probability turning point because liquidity conditions have sort of hit that critical mass condition, or at least from that mathematical point of view. So we try not to be that person that has a hammer and everything looks like a nail. So we try to have a variety of different perspectives of the underlying realities. And then, and a lot of these tools are usually at the beginning of our research process, not at the end. So we go digging, and we've got a variety of other more traditional leading economic indicators on, growth and inflation and different drivers. Another example where we could see that it was a shockingly weak underlying liquidity condition under US corporate high yield credit or fixed income, overly speculative condition, dangerous, and so that was actually primed and vulnerable for anything triggering a pretty significant washout. Now, obviously, this virus shutdown is very unexpected, but the setup was very easy to observe, and this caused us to be, a lot more cautious in our portfolios anyway, and especially when we dug into what was actually going on fundamentally in that sector. So that variety of tools, trying to monitor what is actually happening with the way money is moving around the world or within asset classes, and then the positioning and market structure, liquidity setups. That's sort of a direction, or at least a useful compass to be able to help us to navigate this world where a lot of the historic compasses that investment committees and investors have used to try and navigate environments. So adding that tool to the toolbox should at least make it a little bit more manageable for us in terms of managing investment portfolios moving forward. And we'd like to respectfully suggest to other investment committees and managers that they probably need to pay or find ways to measure and map capital flows and positioning, because that'll be just essential for them to be able to identify and manage risk, and also to surface potential opportunities as the years unfold, especially now that central banks are doing everything they possibly can to disengage, market mechanisms from underlying fundamental realities. So with potentially the amount of liquidity that will be moving around the world in the future, in the years to come, underlying fundamentals won't probably exert as big an influence as the liquidity dynamics are because of what central banks in particular are doing. So this just further expands on some of that. One of the key points is that one of the largest risks in the investment world is not simply the risk we are taking, but the risks those in the environment around you are taking. So pretty important that you figure out and at least have a way of measuring, well, what are those actions and what are those risks that others in the environment are taking. And that's what we can start to see in these positioning data sets and money flows and things. Anyway, this video has gone a lot longer than I was expecting, but hopefully you found it useful, and if you take the time to really dive into this quarterly report, hopefully it should be quite helpful for you. Anyway, this has been Daniel Want from Prerequisite Capital Management. If you have any questions, just shoot us an email or get in touch.